Today, we're diving into Ipsas 13, Leases, an essential standard that brings order and clarity to public sector lease accounting. Have you ever felt uncertain about how to classify or measure a lease? You're not alone. Many public sector accountants face challenges when determining the proper approach to lease accounting. In this video, we'll break down the principles of Ipsas 13, explore the way it standardizes the treatment of leases, and demonstrate how you can apply these concepts in your day-to-day financial practices. Let's begin by looking at the core purpose and scope of Ipsas 13. At its heart, Ipsas 13 is designed to bring consistency and transparency to the accounting for leases in the public sector. This standard offers clear guidance on classifying leases, recognizing resulting financial items, and measuring agreements properly in financial statements. By outlining these procedures, Ipsas 13 addresses the common problem of inconsistent lease accounting practices that can lead to misrepresentations in financial reporting. Imagine this scenario. A government department is leasing office equipment, vehicles, or even entire facilities. Without standardized rules, different agencies might account for these transactions in various ways, making it difficult for stakeholders to compare financial statements. Ipsas 13 solves this issue by specifying which arrangements should be treated as leases and how to account for them, whether you're the lessee or the lessor. It streamlines your accounting process and provides a unified treatment that enhances clarity for both internal users and external auditors. Now, let's address the scope of Ipsas 13. The standard applies to most lease transactions. However, there are important exceptions. It does not cover certain agreements. For example, lease arrangements for natural resources, licensing agreements such as those used for movies or patents, and leases specifically designed to explore minerals fall outside the standard's boundaries. These exclusions help narrow the focus of Ipsas 13, ensuring that public sector entities can apply it with confidence to the majority of their lease transactions. As you move forward in learning how to apply Ipsas 13, recognize that the first step is understanding the key types of leases outlined in the standard. Leases are primarily classified into two categories: finance leases and operating leases. Although these categories may sound similar at first, they have fundamentally different accounting treatments and implications. A finance lease is characterized by the transfer of substantially all the risks and rewards of ownership. When a lease transfers most of the advantages and burdens of owning the asset, it is considered a finance lease. For example, if a city government leases a fleet of vehicles and the lease agreement provides an option for ownership at the end of the term, the arrangement likely constitutes a finance lease. The key here is that the lease effectively transfers ownership-like benefits to the lessee, making it necessary to record both an asset and a liability on the balance sheet. To further elucidate the criteria for a finance lease, consider several indicators that you, as an accountant, should watch for. First, if ownership of the asset transfers to the lessee at the end of the lease term, this is a strong signal. Second, the existence of a bargain purchase option, one that allows the lessee to buy the asset at a price significantly below its expected fair value, also points toward a finance lease. Third, if the lease term covers a major part of the asset's useful life, the lease is more likely to be categorized as a finance lease. Finally, when the present value of the lease payments is approximately equal to the fair value of the asset, and the asset is tailored specifically for the lessee's operations, these are compelling indicators. These elements help nail down the proper classification and set the stage for the subsequent accounting entries. In contrast, when you are involved in an operating lease as a lessee, the accounting treatment is notably simpler. For operating leases, no asset or liability is recognized on the balance sheet. Instead, you record lease expenses on a straight-line basis over the lease term. With this method, each periodic payment is treated as an expense that flows directly to the income statement. A typical journal entry for an operating lease would be a monthly debit to lease expense and a corresponding credit to cash or payables. This approach reflects the nature of operating leases, emphasizing expense recognition over asset capitalization. After addressing the lessee's perspective, it is equally important to understand how the lessor accounts for leases under Ipsas 13. If you are the lessor in a finance lease, Ipsas 13 directs you to derecognize the leased asset and record a lease receivable equal to the net investment in the lease. Essentially, you are transferring the risks and rewards of ownership to the lessee, which justifies removing the asset from your balance sheet. In parallel, you then recognize the lease receivable, which will be adjusted over time as lease payments are received. For operating leases, however, as the lessor, you retain the asset on your balance sheet. Rather than transferring ownership, you continue to hold the asset while recognizing lease income on a straight-line basis over the lease term. This distinction underscores the fundamentally different financial implications between finance and operating leases. As a lessor, you have to carefully evaluate your lease contracts to ensure that you're applying the proper accounting treatment for each type of lease arrangement. Once the initial recognition has been handled, whether you're measuring a leased asset or evaluating a lease receivable, the focus shifts to measurement after recognition and the critical area of disclosure. For lessees involved in finance leases, you will continue depreciating the leased asset over its useful life, while reducing the lease liability as payments are made. Should any changes occur in the lease's terms, perhaps an adjustment to the lease payments, you will need to remeasure both the asset and the liability to reflect the updated terms accurately. Moreover, Ipsas 13 mandates a set of disclosures for both lessees and lessors to ensure that key information is available to financial statement users. If you are preparing financial statements for a lessee, you must disclose future lease payments, any contingent rent arrangements, the length of the lease term, and the discount rates applied. For lessors, disclosures should include lease income details, the level of risk exposure, and information regarding operating lease assets. These disclosure requirements are indispensable for ensuring transparency and providing stakeholders with a clear understanding of the lease arrangements and any associated risks. To bring all these concepts together, let's consider a practical public sector case study. Imagine a city government that leases a public bus terminal for a period of 10 years. The total lease value is approximately $1 million. In this instance, if the terms of the lease indicate that ownership may transfer to the city at the end of the lease, or if the present value of lease payments represents nearly 90% of the asset's fair value, the lease would be classified as a finance lease. For the lessee, the city would then recognize the lease terminal as an asset and record a lease liability for the future payments. Over time, the city would depreciate the asset according to its useful life, while reducing the liability with each payment made. This case not only illuminates the accounting mechanics, but also demonstrates how Ipsas 13 can be applied to very tangible, real-world public sector scenarios. As we near the end of our discussion, let's quickly recap the pivotal points. First, Ipsas 13 provides a structured framework for classifying and measuring leases, ensuring that both lessees and lessors can accurately represent these transactions in their financial statements. We explored the two primary types of leases: finance leases, which transfer most of the risks and rewards of ownership, and operating leases, which are treated as rental agreements. You learned how to identify key indicators of a finance lease and the subsequent accounting entries required from both a lessee's and lessor's perspective. We also reviewed the mechanisms for post-recognition measurement, where the depreciated value of assets is adjusted over time and lease liabilities reduced. And we emphasized the importance of comprehensive disclosures to provide a full picture of the lease's impact. Whether you are managing lease entries for your department or advising on the proper accounting practices, understanding Ipsas 13 equips you with the tools to handle lease accounting confidently. Thank you for joining us on this deep dive into Ipsas 13 leases. We hope you now feel more confident in tackling the challenges of lease classification, measurement, and disclosure. Remember, a well-applied accounting standard is not just about compliance. It's about providing clear, reliable financial information that supports effective decision-making in the public sector. Before we wrap up, take a moment to reflect on what you've learned today. Think about your own experiences with lease accounting and how applying Ipsas 13 could could resolve ambiguities and inconsistencies in your work. Every step forward in understanding your financial practices brings you closer to mastering the complexities of public sector accounting. In closing, we invite you to stay engaged with the Accounting Desk. Like, subscribe, and stay tuned for the next video on Ipsas 14, events after the reporting date. Your journey to mastering public sector accounting continues here. Thank you for watching, and see you next time.